Do you believe these are reliable indicators, and does this mean we're on track for a really strong 2023?
Well, I think 2023, and for that matter, October through the end of 2022, were an incredibly strong period for stocks. And really, what that reflects is the expectation that inflation is going to continue to fall and that the Fed is going to pivot. What's interesting, though, is this year, the flavor of that rally has shifted. We've seen more speculative assets. So, what I'm looking at is companies that were the most sold off going into the start of the year have had the strongest rebounds. Companies that have the highest volatility profile. That profile is one of a speculative move forward in the market, and one that we typically see coming out of recessions. It's actually only mirrored by events in '09 and '02 and '01 when we were bouncing out of a recession. So the health of the rally is really led by speculative assets. I think longer term, it's more problematic for this to continue, given a lot of the headwinds which you mentioned before, such as a decelerating economic backdrop and still inflation on the horizon.
All right, so Patrick, we're looking at futures right now. The Dow looks like it could open up about 100 points lower. The S&P and the Nasdaq also in the red. Of course, this comes off, as we just mentioned, a really strong January. What's changing sentiment all of a sudden? What a difference a day makes. Is it simply anticipation of this Fed meeting later today?
Well, I think we're going to get a refresher from the Fed here. And I think what the Fed is going to remind us is that they're going to stay engaged. It's interesting that we've had a mantra for the last decade of don't fight the Fed. And the Fed is telling you that they want to tame inflation. Surely we're seeing inflation fall, and goods inflation, for example, is in free fall. It's going from 12% this time last year to 3% now. And that's really driving a lot of the decline that we're seeing in inflation. That said, the wage inflation remains problematic and the labor market remains really tight. So I think the Fed is going to indicate that they are going to remain engaged until they see something that is much lower than what we have here. And the market is not ready for that after the month we've seen in January.
So you're saying the market's not ready. So exactly what is the market ready for? We've seen, like, again, a very strong January, but a lot of apprehension and tension about a pause or a pivot, even though the Fed hasn't given any signals that they're going to do either one. Number one, do you believe in the consensus of a 25 basis point hike in today's meeting? And what do you think is going to be the response? Is that already priced in?
Yeah, so when you look at what the market's expecting, they're expecting 25 basis points this meeting, and they're expecting another 25 basis point hike. So I expect that that's largely priced in. So the move itself, I don't think is going to be all that surprising. And I think the Fed has indicated that they remain data dependent, so they're going to slow as inflation slows. What I think, though, is going to happen is we're going to reach a point later in the year, probably closer to the end, where inflation remains sticky. So right now, inflation's falling because goods inflation's falling. The price of oil, the price of everything that we purchase at the grocery store or other items. But services inflation remains sticky. And that's a big it's a big component of that is driven by labor. And that remains problematic because the labor market is incredibly tight. So as we get to the back half of the year, probably perhaps into October, we're going to see a dilemma that the Fed's going to face is can they or have they solved the wage inflation? And if not, then the re-engagement there is going to be problematic for stocks. And we expect a sell-off if that happens.
All right, Patrick, you know we like to keep score here on Worldwide Exchange. What's your S&P target for 2023, and how much has it changed over the last couple months?
So right now, our S&P target is for 4050, which is a little bit lower than what we have here. We think the rally that we're in right now has the ability to continue throughout the first half of the year, and that's been our expectation. Volatility is falling, credit spreads have come in an environment that is really favorable for risk taking, and the market has really responded favorably to that. I think, though, as I laid out a minute ago, I think the concern that the Fed may need to re-engage in the latter part of the year, or the fact that recessionary risk, which I think a lot of investors are calling for a soft landing, but recessionary risks haven't really been taken off the table. I think those are going to be a headwind for the market as we start to approach the latter half of the year. And as a result, we think we end lower from where we are now.
All right, Patrick, I want to run something by you. We just got a tweet from Jeffrey Gundlach just a second ago. I'm going to read it to you. I want to show it to the audience as well. He said, I suspect Fed messaging tomorrow will push back against the pivot narrative and thereby current bond market pricing. Should be interesting. I got to correct myself. This was actually late last night, but we're just catching on to it right now. I'm going to read it one more time. I suspect Fed messaging tomorrow will push back against the pivot narrative and thereby current bond market pricing. Should be interesting. What's your opinion on Jeffrey Gundlach's take?
Look, I think I largely agree with Jeffrey Gundlach. I mean, right now, the Fed has the credibility that they need to fight inflation. And any ground that they give in that conversation could just further fuel inflation. And it's a very delicate balancing act to tackle inflation because part of it is something that gets in the ether, in the water, and they need to ultimately stamp that out. So they need to walk the line until the moment they stop. And they've indicated they're not stopping right now. So I expect them to maintain that line as long as inflation remains problematic. And like I said, we're not out of the woods. There's many factors, such as wages, that are going to be a problem for the Fed down the road.